Thanks, Jonathan. Good morning, everyone. Let me introduce the panel today. We've tried to make it an interesting mix of people across the foreign exchange and business world and one football person. We've got Kevin Rogers, who I think joined Merrill's in 1990, if memory serves me correct. Ended up running FX for Deutsche Bank and globally. We've got Tom Gilly, who has been based in Asia, New York, and London for 20 years, running Credit Suisse, and probably the last role he was doing is running global FX trading for Bank of America Merrill Lynch. Mark Zaffran. Mark is the slightly more new kid on the block. He's currently the global head of FX sales for Societe Generale, based in London. And Damien Comolli, who has nothing to do with trading foreign exchange himself. He, I think, started his career with Arsene Wenger at Monaco, if that's right. Was part of the team, or head scout for Arsene, signing most of the Invincibles to Arsenal. Was a sporting director of Tottenham, notably signing Gareth Bale. Then was a sporting director of Liverpool, probably notably selling Torres for 50 million and signing Luis Suarez, who also ended up being sold for a nice little profit. So look, we're going to try
So this is about football, not about FX today.
If we were to compare the management here with kind of, let's say, current football guys, you have Kevin, who's like the Alex Ferguson. You probably have Tom, who's, I want to say, a slightly older version of Mourinho. Mark, who is probably my Pochettino. And Damien, you can probably be yourself. So look, I'm sorry about that. So look, first question I wanted to do, and if anyone has any questions that they think is relevant or they're interested to talk about, feel free to throw an arm up and we'll have a microphone around here. But look, it's been an interesting week. A few things have happened to kind of make the markets move. Mark, I tried to get hold of you on Friday and you sounded a little bit stressed. How was last week for you, and anything notable to talk about?
Well, a few things to talk about, and indeed last week was not the easiest week of the year, but it was very interesting. I would say that was probably the busiest week of the year after the Brexit, or comparable to the Brexit in terms of volumes. The volumes picked up. We had major rotation from EM assets into dollar, into equity, into dollar equity, from asset management, hedge funds. I mean, it's been a very geopolitical year. And the last 2 years have been very geopolitically important and centric when it comes to FX.
Kevin, did the markets kind of think that Donald was ever going to get in, and did they react accordingly? I mean, what are your thoughts?
Well, clearly not. I mean, I don't think many people did. I think I was picking up backing Donald at 5 to, not that I wanted him to get in, but like backing him at 5-1. You know, kind of with hours to go in the election. Clearly, it's a shock for the markets, but you know, kind of for the foreign exchange business as a whole, I think it's is probably a positive development, because you know, the one thing that is unique about FX is it tends to do better when things are volatile. And you know, kind of having a president who's untested, who's fairly volatile himself, especially on some pretty critical issues like NATO, for example, like the debt. Will introduce more volatility into the markets, and I think you know, kind of that will be, in terms of the FX business, will be a healthy thing going forward.
I mean, do you think Trump is good for business? I mean, obviously, I don't want your views, Tom, but I mean, you have to look at how the American banks traded versus the Dow Jones. They seem to be all positive. I think even you were saying Deutsche Bank stock has gone up a little bit as well. So
yeah, from a low base, obviously. Yeah, no. Clearly, when you have a sort of edge effect event like Donald Trump coming in, and you don't know what the outcome's going to be. You know, one potential outcome is that regulation will be rolled back. You know, Dodd-Frank might be rolled back, and that, you know, is a good thing, maybe not for society as a whole, but certainly for the banks that are affected by regulation. So in that respect, yeah, whether he'll be good for business kind of globally, I very much doubt. I mean, I think, you know, kind of as a student of economic history, a sort of return to, you know, Smoot-Hawley from the 30s isn't a brilliant idea.
Tom, do you think how does this impact London? And there's lots of talk about companies moving, etc. What's your thought?
So Brexit rather than Trump.
Yeah, exactly.
The obvious point for Brexit is what everyone knows, which is how they negotiate the passporting agreement on an exit, and does that cause people to change? For me, and that we don't have an answer to, if there's no passporting, it's going to force something to happen, of course. But I think what's more interesting is actually where are they going to go? There's no office space, right? If you think about the number of people that would need to be put somewhere else, there simply isn't a city in Europe that can house them in the short term. So if you're worried about it, I think you should buy European commercial real estate as a hedge.
Mark, you work for SG.
Yeah.
Obviously, you probably have to be very careful what you say, otherwise it will all be in the
I
newspapers.
think Soggen has communicated quite extensively on that, like many European banks. I mean, this bank, Soggen in particular, is very well equipped in front of the Brexit because of the presence European-wise. So if we have to redeploy people in Paris, in Frankfurt, in Madrid, it's something we can do fairly easily. To the question of whether London will remain the center, I actually believe so. I think obviously there will be a component linked to the passporting, to the hard Brexit versus soft Brexit, and so on and so forth. But anyway, when you look at the BIS survey in terms of volumes, in terms of FX, I mean, what we can see is a major rise of Asia, Hong Kong, Singapore being almost at par with London, which is something pretty new that we've noticed this year when the survey was released. And at the end of the day, this will remain a key center. The continent will benefit, but will benefit to a certain extent. And I think the one who will benefit the most are probably consultants and lawyers, and many of them are in London. So that's not over.
Kevin, with all the regulation and changes, and we always talk about the big five. I don't know who the big five in FX is anymore, but the market, those big five have been dented. There's market share being changed across, let's say other platforms, and you've got a lot of friends that have moved to other platforms. I mean, what's your view on, the changes and how, let's say, smaller players are going to be able to grab more of that market share?
Yeah, I'm speaking again this afternoon about, and this topic comes up, so I don't want to give spoilers, but I think that banks are really under quite a lot of pressure, and I think we've probably seen the kind of high watermark of concentration in the FX market making space for a number of reasons. The first is banks as a whole are kind of under regulatory pressure. Kind of the old way of leveraging is being squeezed. So that's the first thing. Second thing is that means that ROE and return on assets is being squeezed as well, which means that kind of within banks there's just less ability to invest, even in stuff like foreign exchange, which is actually a very, very good place to invest because it's actually a very attractive business because it uses very little balance sheet. So what's happening is in a very technologically dominated market, banks' ability to compete is being compromised. First, because they're tied to a bunch of legacy systems, and the problem with legacy systems is, kind of what we used to call in Deutsche Bank, the run the bank costs, the fixed costs of keeping them going, won't diminish if your market share diminishes. And so that squeezes the amount that you can do to invest to reinvigorate them and change them. Whereas new competitors coming in start from a clean slate. I mean, an analogy would be, the London Tube system, which was put in, kind of 1870s or whatever, and, if you ever have to use it, it creaks a bit. Whereas, you go to Shanghai and they just built the thing from scratch and it works like a dream. And so that is one issue. The second thing is, kind of with restrictions on pay within banks, hedge funds who want to come in and start competing on market making, they've got a great ability to pick up good talent. And then, and then the last thing, is there are lots of, the idea of the one-stop shop for banks in general, that you had to be able to do M&A, you had to do equities, everything, I think has died. That's over. And it's sort of over within FX. So you can get people, kind of XTX are a great example, who come in and just offer one piece of the FX puzzle, and people will deal with them. So, all these sort of trends, I think, are problematic for banks.
Okay. Look, Damien, we've established that you're the non-FX person here, but I suppose...
Good guess.
Why are you here? No, I know
Because we
you're,
like him, because we like him.
Sorry, I couldn't resist it. You're speaking to banks, you're speaking to hedge funds at a kind of management and strategic level. What are they asking you?
Well, basically, it's everything that has just been said, or a little bit that I could understand, which comes back to, you know, those guys live in an incredible, and people in the room probably, an incredible volatile environment, as far as I understand it, and so do we in football. So most of the things that come back and questions that are being asked to me from those institutions are, how do you deal with a very volatile environment? And in the sports world and my world, which is football, and when you work in the Premier League, we play between the top clubs between 50 and 60 games a season. So basically, you are in a situation to having to deal with a crisis every 3 days. It's not a geopolitical crisis. You're not dealing with the president of the United States being elected, but you could sack your manager every 3 days, and you are going to end up, you know, in the back page of the Sun every Sunday, potentially. So that aspect of dealing with a very volatile and very competitive environment. The other aspect that comes back constantly is, how do you build a high-performance environment? How do you implement culture? How do you implement and develop your values, core values? And the last point, which is my kind of specialty, is really about talent. So where do you find your talent? How do you retain the talent? And how you develop your talent within the football world or the performance world. We were talking about, with Kevin last night, about building a team of traders and building a team of footballers, and the bridges and the similarities around it, and then managing it as well. So I think we were talking about this, you know, we were talking about the same things, really, the same challenges, which is fascinating.
Okay, sorry.
Yeah, actually, what Damien is talking about is crucial, because our business is a lot of automation and more automation, and Kevin's book is actually amazing, a great read on that point of view regarding the evolution in between automation and what the people are doing on this trading floor eventually. But there is, you know, we are still there, we are still on the trading floor, and actually I asked, it makes me, I recall I asked Damien to speak to our team on the fixed income trading floor of SocGen a couple of months ago, I believe. And that was quite important, because when all the bank wants to juniorize, to have more junior on the trading floor and to attract the right talent, it's actually not given. 15 years ago, when I was junior, I was dreaming to work for Tom, for Kevin at Deutsche, at Merrill. Now, you know,
yes, we are that old.
Yeah. now we are. Now this is established. Now this is established. I can carry on and say, you know, now when we go and in the top university across Europe, the guys, they don't want to come to work at Deutsche and Merrill. Even SocGen, they you know, we are not the first stop for them. The first stop is Google, Microsoft, Apple. And that's not because there is just a new economy. This is because there is the culture that they found appealing, the drive that they are looking for to find. And I think the banking industry has a lot to do here in terms of reforms, not only in terms of reforms of, you know, its setup, its IT system and so on, but how do we make this business, which is still a very attractive business, appealing for the new generation. And I think it's about team cohesion, attracting the right talent, and making sure that those people want to be a part of something appealing for them. And music to my ear when you speak, sir.
I mean, what is very clear, if throughout the performance world, you know, if I go beyond my sport, but you go into cycling or NBA or rugby, one thing that everybody talks about, there are studies out there showing that the teams, the sports organization who have got a strong culture, outperforms other teams by organization by about between 30 and 40%. So culture is a competitive advantage. It definitely is. Where we look at competitive advantage in sports, in football, the first one is culture. The second one is talent. The third one is, how do we develop the talent? So talent management. So acquiring talent, developing talent. The fourth aspect, which got nothing to do with your world, is about sports medicine, sports science. So you're not going to train your guys in terms of fitness. And the last aspect is data, which is huge in your world. So how we use data, how we use analytics, not only to recruit talent, but to use our talent in a proper way. Those are the 5 aspects that brings competitive advantage to any team. And when coming back to what Mark was saying, the 3 companies that you name, I was at a sports conference last week in London. We had a head of culture from Google coming over, and a lady, she was outstanding the way she talked. And you are exactly right. It's about culture. And there is a guy last week, he won, as a performance director, he won, I can't remember how many gold medals in 3 or 4 Olympic cycles. He's very, very good at what he does. And he turned around to me in a conversation, he says, why is the Premier League so competitive? And I told him it's very simple. There are teams now that are so good in terms of culture and values and having continuity and sustaining that culture throughout that it makes very difficult for all the teams to compete. So that culture aspect is definitely a strong competitive advantage.
Okay. I mean, Kevin, you managed Deutsche Bank in its heyday. You kind of ran it globally. The market is changing a lot, whereas if investment bankers would normally leave to go to another investment bank, and more now we're seeing that they are moving to a lot of the companies that are here, a lot of the retail stuff. What's your view on that?
Well, my view on it is good luck to them, basically. Now I'm retired. Obviously, when I was at Deutsche Bank, I'd have thought it was a terrible idea for people to move there. But, I totally agree with, kind of what Damien and Mark are saying. It is about talent acquisition, it is about talent management, it is very much about culture. And, it's absolutely right. Banking back when I started, which was in the Stone Age, was the place that smart young guys and girls wanted to go and work in. That was, it was the cutting edge. It was the cutting edge of technology. It was where it was all happening, and it isn't anymore. It goes back to what I was saying about the pressure on the top 5. So, if you want if you're a young market professional now, why not go to a startup or a small technology company? Maybe the culture would be better, and you won't have to put up with some of the legacy issues that infect the world of banking these days. So it's perfectly sensible as far as I'm concerned.
In a world which is so competitive, I think you are going to attract the talent and retain the talent if they see the light at the end of the tunnel. So if the talent think that you will have the culture in place to develop them and to make them better and to allow them at some point to improve in their career, then they will come to you. That's why they go to Google and all those places. That's why, sorry if people are not into football in the room, but the reason why Tottenham Hotspur have got a lot of talent and they can keep them at the moment is because they pay them less than in other places, but the young players want to stay there because the culture is right. So that's the first aspect. The second aspect, which we see a lot in the football world, in the performance world, is you have to have a culture where you allow failure. And too often, we see things where if you fail once, you're dead. You're dead in your profession. If you fail, if people are not comfortable making decisions, developing themselves and taking risk if they fail to fail. Yep. The strongest message as a sporting director running big Premier League clubs, the strongest message as a leader I've ever given was, I was wrong. Because as a leader you say, I was wrong, then everybody in the room will relax and understand that failure is a possibility, and failure is not a trauma, it's not a drama, it's a way to improve. And there is, sorry, Tom, I've just finished. There is this fantastic quote from Michael Jordan. He says, everybody thinks I was a success. I lost over 200 games. I missed 9,000 shots. 26 times I was asked to take the last shot to win the game, and I failed. And I failed and failed and failed again, and that's why I succeeded.
Okay. Tom. Just adding on the culture piece, a big challenge for the industry, and I'm sure it was the same as Deutsche, right? The growth of the electronics to the point where 90% of volumes going through the businesses are delivered electronically means that we need to be recruiting, as we've just been saying, the high-tech guys who are going to Google, Microsoft, but the businesses are still being run by old voice traders such as ourselves, who don't necessarily completely get the culture, right?
But when you were at Bank of America, Merrill Lynch, I know because I was kind of working for you. You would never lose people. you would never lose people. Your retention rate of staff was
We lost one.
Yeah, which was really annoying because I couldn't do any replacements for you. But what was your trick?
What we tried to do was ensure that the business was relatively flat, that everybody felt that they had a voice, whether you'd been there 5 minutes or 15 years, that everybody understood what we were trying to do and why we were trying to do it. So we were trying to build exactly what we're saying, a culture where people felt part of something and actually agreed with and bought into the long-term strategic vision. And I think it helped that, you know, when you get momentum, I mean, everybody likes to stay on a train that's moving that direction, right? So, I mean, I'm not going to take all the credit for it as a manager, but it was very much around culture.
I mean, Mark, what are the banks doing? We read a lot that, you know, they're cutting staff and this, but I mean, are you hiring or tell me about your business?
We are reforming, and reforms implies reshuffling of the team. So more junior, more people with an IT and high-tech, fintech background, more people understanding transaction business, obviously, but also the risk, and being attentive to regulation. You know, we're gonna have a huge. We are going through huge switch in terms of regulation. We are moving with Emir from counterparty risk to liquidity risk. The pricing is impacted. We are not delivering pricing, you know, just reading a screen. We need to have people who are well-rounded in terms of delivering, you know, client's advisory, but as well understanding a new mechanic behind. So there is a need I mean, the banks are reforming, and with reform, you need new people.
Kevin and Tom.
I just recalled the one guy we lost went to Deutsche Bank.
Yeah?
You want to talk about that right now?
Was it Kevin who took him?
You want to have a discussion, guys?
I was going to look on recruitment. You and Kevin were both prop traders and traders in your DNA. It's what you do. But with banks not being able to take prop risk anymore, how are the hedge funds going to find the next generation of prop traders and portfolio managers?
First of all, they are allowed to take risk
Okay.
in FX. Spot foreign exchange is still outside of any restrictions. That and US Treasuries, which actually is another reason why FX should be a focus. But secondly, define prop risk, right? And we've been talking about it now. Most of, a huge amount of risk now. Ask Renaissance. How's Renaissance trading? Right? It's computers, right? It's not, the human macro trader is a dying breed. They still exist, but they're not being groomed, right? The spot trader sitting in a bank. I mean, actually, a good question, Kevin. How many spot traders were in Deutsche London in 1996?
I wasn't there in 1996, but I know the numbers. It was probably 30. Yeah.
How many are there?
Probably about 5.
Yeah.
That's the voice guys, not the E guys.
No, understood. My point is that when it was all voice, you sat on the desk and every single thing the bank did, you could feel. Now, 90% of it is going through the cables under your feet. Right? You don't have the visibility that you had before, and that's really hurt the trader's ability to take short-term risk. And then the macro world has become very difficult, partially because of the growth of hedge funds and the aggressive squeezing of any opportunities, and partially because we live in a very strange world where Donald Trump can go from losing to winning. And
do you have a view on prop traders coming through?
Yeah, I mean, I totally agree with Tom here, actually, that the way that banks operate because of especially in FX, because of the electronification, means that skill set isn't really kind of being developed. But it isn't just in FX. I mean, actually, I consult to a fund that does my other asset class commodities, and they have exactly the same problem because, there's very few people coming out of banks these days who have that skill set because banks are simply not allowed under the Volcker rules to take risk, and Dodd-Frank has basically made it uneconomic, which is why you've seen bank after bank kind of row back from being in those markets. So I think across the board, the ability to macro trade has been undermined, and partly for the reason that Tom just said. Kind of actually the world. How do you trade a market like a Donald Trump, and how do you trade a market where there's very few interest rate differentials?
Okay.
To something that Damien said earlier about big data. I mean, the question that banks should be asking themselves, and I think the smarter ones are, is what is your edge? Right? Where is your advantage in this market? Right? You're facing off with some of the smartest hedge funds in the world who are talking to every bank on the street. They probably have more information than you, right? 20 years ago, our advantage was we knew where the price was and the customer didn't because it was all voice. That advantage is gone. And the answer is, and this is something that the legacy systems that Kevin talked about causes trouble with, is that the bank's only advantage is that we have 10, 20, 50, 100,000 customers across different asset classes. And if you're not data mining the activity and looking for the correlations in that data, then you're not exploiting the only advantage you have left. And the systems that are in place in most institutions don't allow you to do that in anything close to real time.
In your book, you talk all about, obviously, the Autobahn and automation, but is there a limit to automation, and have we reached it?
Unfortunately, kind of for the human beings in this room, I don't think so. I don't think there is, kind of my key point really about automation and systemic change within financial markets is that, kind of it's a combo of what the regulations will allow and the ability to automate. So people will automate as computers get faster and faster to the limits of what they can do. There's no limit on the speed advantage in FX. Therefore, you get an arms race to the point where it matters whether you use microwaves, right? So if I look around, not just in foreign exchange, but in banking as a whole, it's perfectly possible for people to go, well, kind of my job, it's kind of there's the human element to it and you can't automate it. But I just think that's wrong, actually, because most jobs, I'm an options trader by training, and kind of I'd have thought, well, actually, most of that trading options is really difficult to automate, but it damn well isn't. All the stuff that I was paid for back in the early 90s, like being able to make prices and be able to interpolate on the vol surface, computers can do that a million times better. Kind of is really the ability to trade gamma and put your FX orders in like non-automatable. No. So really, to me, kind of anybody who does any kind of job, and then this doesn't just apply for banks, it applies to every institution that's sort of basically information-led. And if there are aspects of your job that are pretty much routine and you're not really thinking hard about it when you do it, eventually it'll be automated.
Okay, Mark, do you have a view?
I agree. I think there is a major room for further automation. At the same time, when we went, through, for instance, this year the Brexit, U.S. elections, last year CNH move in August, Swiss franc, you see that automation maybe doesn't have its limit in terms of progressing, but you see the importance of still having. You see the importance of the human factor. First of all, your clients want to speak to someone, and better to have a lovely voice than a computer one over the phone. And then, the platform are not switched on yet completely fully and fully tested for every kind of event. So there is still a very important human element, but I fully agree with Kevin. The room for further automation is ahead of us, and further automation doesn't mean completely suppressing the human element. It means that the human element is going to be redistributed on the trading floor, and the jobs are going to change.
The critical thing, what I just said, I think, is if you're not thinking while you're doing your job, if you're just doing it automatically, then it will be automated.
I fully agree.
But if you are actually adding value as a human being on a trading floor, then you will not. So that's the key thing. What will happen is you'll just get fewer people who are just way better and way smarter and way probably better paid.
Fully agree.
Okay. Look, in your book as well, you also mentioned about the three big forces in FX being momentum, valuation, and carry. Any idea of what 2017 is going to look like for us and how those big forces are going to come into play?
Well, I mean, this is a kind of technical point that, kind of momentum, which is, if it's going higher by more of it, if, and valuation, which is the sort of trade balance, PPP, Big Mac index thing, kind of always were outweighed by the force of carry, which is interest rate differentials. That was the big thing driving FX markets. And that kind of has been switched off for a few years. In my opinion, this is why macro funds have been doing so awfully recently. Kind of that's the underlying reason, because the market's untethered, and so you just get these weird kind of moves going on. Whether that will last, who knows? I mean, we've started to see the interest rate markets move at the back end. Kind of whether we're going to get out, when eventually we get out of a zero interest rate policy, kind of global zero interest rate policy, that's when I think, kind of things will get interesting again. But for the time being, it's a very hard market to trade, I think.
I 100% agree, and it's just worth noting that the Trump victory probably puts the end to Janet Yellen as Fed chair. Her term's up early 18, right? Which I think is also showing through in the interest rate market. So that's something that's going to develop over the course of the next 6 to 12 months, and who they start looking at for that seat and the sort of economist they are is going to have a big bearing on the U.S. interest rates and hence through to foreign exchange.
Sarah Palin, maybe, I don't know.
Yeah, that would be interesting. 2017, I think. I mean, for me, the three key the three key words for 2017 will be more geopolitics. More geopolitics. We've got French election coming up, and we've got already fast money clients positioning themselves for that. It's quite impressive. So there will be more geopolitics around the Brexit, around the elections, around what Trump will be saying one week or another. More geopolitics. Second thing that will be, I think, really key will be the macro that Kevin was alluding to, and linked to politics as well. Trade deficit, trade imbalances, I think this is going to be key because on emerging market that will make, if we are in a world which is moving from full globalization to more bilateral agreement, this will make a huge difference. And emerging market will not be traded as a pack, but Turkey and Russia will be traded very differently from a macro perspective. And finally, a big thing is, in my opinion, for next year, more than ever, liquidity. Liquidity linked to regulation in particular. Again, we're going to be, and the whole industry is going to go through new regulation. One of the main principles of the EMIR regulation, and I'm sure there will be some fun workshop dedicated to that, but one of the key principles of this is very much moving to liquidity risk versus the analysis of a counterparty risk. Where the market is going to find this liquidity, I think this is, a new deal for the street, and I think liquidity will be, a key word for next year.
Okay. Buy or sell peso.
Sorry?
Buy or sell peso next year. All right. Look, should we throw it to the floor? Does anyone have any questions they'd like to ask any of the guys here? Oh, come on, give us one question. We got one over there.
Given that, spot pricing is very generic on the street and the amount of funds we have here. Sorry?
We've got a mic coming just over there.
Yeah, given that spot pricing is so very generic now these days, and it's very hard for banks to make any edge. Tom obviously working with you previously in the options market, and it seems that the agency desks are kind of growing in numbers and winning a lot of market share. Do you think banks are going to continue to, as you just mentioned, Mark, giving liquidity to these guys? Because at the end of the day, you're just kind of cannibalizing your own market.
The agency broker business has targeted fairly specifically so far, at least in my experience, the small to medium-sized hedge funds who don't necessarily have the relationships to get the breadth of prices available to the full-grown guys. So the approach that we always had with them was that so long as it's not cannibal, if we have a direct relationship with that client, why would I ever show him a good price through the agency? That makes no sense. On the other hand, if this is a client who's new to my platform who can't access me without the agent, why wouldn't I make him my price? Right? Our business is the spread. I don't care in the end if the client's paying the agent a piece on top or not. If he's crossing a fair spread to do fair business, I want to see that.
Okay. Anyone else want to add anything? Or?
I'd just like to say I totally agree with Tom, but we never discussed it beforehand. So,
Anyone else got any other questions? No? Okay. Oh, hang on. We've got one here. We've got the microphone just coming over.
A lot of concerns coming into the foreign exchange market with flash crashes, the last one being the cable flash crash that was at suspicious hours, prompting a central bank investigation. Given what you're seeing with the electronification of the market, do you think flash crashes are inevitable and we should just react to them in the same way that we did back in the voice days where we saw comparable moves?
I'll answer that question. I think first, yes, we will see more of them. And it's a natural consequence of the automation of markets because they become more convenient, they become more transparent, but they become more fragile for various reasons, you know. I actually doubt whether something that the cable flash crash would have happened 20 odd years ago. I don't think you saw 10 standard deviation moves in a currency as important as cable, which is like the biggest and fifth biggest economies on the planet, and 9% I think of total volume, ever happening.
Without an underlying driver.
Without an actual data point coming in, because this was just out of nothing. And I think that is the way, unfortunately, the markets are going to be. You've got a trade-off between the convenience and transparency of electronification, but on the other hand, you've got markets that are slightly flakier and more fragile. So I think it's inevitable.
And to Kevin's point around putting thought into your job, the machine doesn't sit there saying there is no reason for this move, it's a liquidity event I can absorb and I'm sure I'll be fine. The machine just says, oh, volatility, make it wider. And you get this cascading effect, right? And this, to the point that there still is a place for human traders. The machine is not obligated to make a price, or not obligated to make a good price. The human trader generally is obligated to make a price.
Okay.
Yeah, I mean, in the old days, somebody would just go, yeah, cable down 3 big figures, I'll buy some. That's, I mean, inevitably, right?
Okay. Look, thank you very much to my panel. Thank you very much for coming today. And, well, thank you.
Thank you, Greg.